Today, risks are building and mortgage holders are in the front line. Hello again, it's Martin North from Digital Finance Analytics, where latest post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the impact of rising home prices around the world against the rising debt and consider some of the risks lurking below the waterline. A few months ago, the Credit Suisse Global Wealth Report declared Australian households the world's richest thanks to their expensive property assets. But you've got to ask, how real is the wealth effect, and what happens if borrowing rates were to rise? According to Mortgage Business, the chief of Australia's largest bank has said lenders should act preemptively and shift their floor rates for mortgage serviceability amid surging house prices. Speaking to the House of Economics Standing Committee of Economics on Thursday, CBA Chief Executive Matt Comyn said the bank is growing increasingly concerned with rising housing debt and house prices. Comyn commented that he'd not worried about the past growth rates for housing prices, credit and income in the past 12 months, but there could be trouble in the future. As we've seen in other markets, New Zealand being a good example, but not limited to New Zealand, in many developed markets, it is much harder to act when the market is accelerating versus taking interventions to try to avoid too much of an acceleration, he told the committee. I think we would all have a shared concern about making sure that Australia's households are in a strong position to continue to repay debt, but also support broader consumption in the economy in the second half of this decade, if interest rates were rising and if potentially they were to rise more quickly. CBA raised its benchmark serviceability floor in June to 5.25%, stating it was an effort to ensure the bank continued to lend responsibly in the current low-rate environment. Comyn explained the change was the bank's preferred mechanism to deal with rising debt levels and that it would be important for the sector to take anticipatory steps rather than reacting. We think we and the industry could obviously, I don't want to speak for the rest of the industry, but we think it could be important to take some modest steps sooner rather than later to take some of the heat out of the housing market, he said. But I want to be clear, I'm not concerned about the point that we are at today, but based on the acceleration, I think it will be prudent to act sooner rather than later. The day before, the Reserve Bank of Australia had similarly raised the alarm on the housing boom and rising debt levels, warning it could lead to cracks forming in Australia's financial stability. Driven by low interest rates, government stimulus such as home builder and rising prices, the RBA expects housing credit growth to peak at an annualised rate of around 11% early next year from its current level of around 7%. In the event of a shock, RBA Assistant Governor Michelle Bullock warned the banks with around 60% of their loan books being in mortgages would be highly exposed, while high households of household debt could also considerably weaken spending and in turn the economy. ANZ CEO Shane Elliott also recently made comments stating that in the current environment, banks should tighten their lending standards and they shouldn't rely on regulators to do what is right. Appearing before the committee on Thursday, Elliott reported ANZ is being more careful, taking more time to ask more questions about the loan application process and to assess borrowers' capacity. Comyn noted that CBA has had regular dialogue with both the Reserve Bank and APRA, and echoing Mr. Elliott, commented the best regulation is self-regulation. We shouldn't be entirely dependent on being instructed by the regulator, nor were we in June, he said. Despite a fall in business and consumer confidence through the lockdown period in Sydney and Melbourne, CBA has not seen a slowdown in applications and fundings, with the market still being very alive. Comyn also commented that there had been a slight uptick in investor applications, but it is not yet at concerning levels. If we went back to 2015 in markets like Sydney, we were seeing 65% of applications being in investor. We were seeing investor lending growing at more than 10%, he said. I mean, it's 2% now, so it's a very different composition of the market. And earlier in the day, Matt Common was also asked about his thoughts on SME lending and its take-up of government-backed SME loans. He outlined that CBA had lent just under $2 billion in funding to more than 20,000 businesses for the government-backed SME guaranteed loan scheme, representing 4.5% of the total pool. Then he highlighted that the individual schemes were quite tailored and direct, with eligibility ranging from cash flow constraints or supporting SMEs that were dependent on JobKeeper. He therefore suggested that perhaps lower take-up was more a function of the support that was available, including deferrals, rather than a lack of appetite for the funding. He told the committee that CBA had deferred more than 80,000 small businesses from their loan repayments and had actually seen its overall lending to business at 11% in 12 months to the 30th of June, its strongest lending growth for more than a decade. However, he added that SMEs were under enormous pressure at the moment. I think there is enormous pressure at the moment, even though I would say that the request for financial assistance has been fairly modest at the smaller end. Probably about 60% of those customers don't have a loan. They've seen equity in their businesses, often their life's work, reduce. They're under tremendous stress and frustration. They don't necessarily have the resources that a large company has to draw on. And while Common acknowledged that there was significant government and financial support in place for businesses, he added that it had been clearly a very challenging few months, particularly for small businesses in the central business districts of Sydney and Melbourne, many of whom had not recovered from last year's lockdowns. And he flagged that CBA had this week announced that it would be offering merchant customers accepting card payments a flat rate of 1.1% for all in-store transactions and 1.5% for online transactions to help support them. Now, over in New Zealand, the central bank has further tightened already existing restrictions on high LVR lending, as we reported yesterday, amid fears around a rise in risky lending. On Thursday, they confirmed that it would tighten the amount of lending banks could do above an LVR of 80% to a tenth of all new loans to owner-occupiers. That's half of the current 20% limit. The new settings from 1 October have followed earlier restrictions in March when the Reserve Bank in New Zealand installed LVR restrictions on both owner-occupiers and investor loans to 20%. They then further capped limits for investor lending to 10% in May. The Deputy Governor and General Manager of Financial Stability, Jeff Buscard, reported lending at LVRs greater than 80% had already tripled since 2017, with the majority of loans going to first-time buyers. Meanwhile, in Australia, APRA recorded a rise in high debt-to-income lending during the June quarter, with its chair Wayne Byers expressing concern. However, the watchdog has said it has not yet commenced any action, as other risk metrics have decreased. Both the Prudential Regulator and the Reserve Bank are monitoring the housing and lending markets, having discussed what tools they would prepare to use should they need to intervene. And the RBA Governor Philip Lowe pointed to example measures such as raising the minimum interest rate banks use for home loans, or limits on high loan-to-value ratios, or high debt-to-income lending in banks' portfolios. Considering if Australia could mirror New Zealand's strategy, Common expressed some doubts. Some of those measures also impact particular cohorts of borrowers more than others, for example, first home buyers, he said. If you're asking me, what do you think the preferred implementation mechanism? I would suggest that it's the benchmark for floor servicing. It's very transparent, it's very easy to implement, it's effectively the rate that you're testing serviceability. You can apply it to banks and non-banks. Stretching the floor servicing benchmark could impact first home buyers who are already at the maximum of their borrowing capacity, he said. But he didn't believe that it was a perfect sort of public policy measure, and it would be hard to design. Similarly, Elliott noted, I think whatever tool you choose, there's always going to be some winners and some losers from it. However, the ANZ CEO commented such macroprudential could have entrenched positions in the competitive landscape. Now, total household wealth reached a high of $13.4 trillion in the June quarter, primarily due to rising property prices, according to data from the Australian Bureau of Statistics. Figures from the ABS have shown total household wealth rose by 5.8% or $735 billion in the June quarter, with residential property assets contributing 4.5 percentage points of the quarterly growth. Superannuation balances and direct shares followed at 1.1% and 0.3% respectively. Wealth per capita has risen to a record high of $522,032, so I hope you're feeling wealthy. ABS Head of Finance and Wealth, Catherine Keenan, commented residential property prices had recorded their strongest quarterly growth on record of 6.7%. Additionally, non-financial assets owned by households had increased in value by 6.4%, or $782.2 billion, and there's been a $576.5 billion rise in land and dwellings. The strong property price growth reflected record low interest rates, rising consumer confidence, and demand being greater than the levels of housing stock on the market, she said. Demand for credit came to $78.6 billion. That's a rise of $25.5 billion over the quarter, of which households borrowed $45.1 billion. Household demand for credit was the strongest it's been since the June quarter in 2007, with most consumers chasing new housing loans amid the heightened property market. There was a $38 billion rise in housing loans and an $8.7 billion increase in unincorporated business loans, which drove an overall 1.8%, or $8.7 billion growth in household liabilities. Of the new housing loans, the bulk, at $31.9 billion, had been owner-occupier, compared to $6 billion for investors. Meanwhile, private non-financial corporations borrowed $13.3 billion, although the bulk of funding came from equity raising. Meanwhile, the deposit assets of banks with the Reserve Bank of Australia increased to $341.8 billion as the central bank injected further liquidity into the financial system in line with its monetary policy goals. The liquidity helped the quarterly growth of $26 billion, or 1% in the bank's loan assets. Growth in owner-occupied loan balances was the strongest in 5 years and consistent with ABS seasonally adjusted owner-occupied loan commitments data, which reached new highs over the first 6 months of 2021, the ABS said. Deposit accounts with banks grew by $45.1 billion, or 1.7%, to $2.7 billion. And the ABS noted that for the first time since the onset of the pandemic, private non-financial corporations have driven the rise in deposits, keeping them steady through April and May before increasing them in June as lockdowns began in New South Wales. Households, meanwhile, saw their weakest increase in deposits in 2 years due to increased household spending pre-lockdown, or perhaps lower incomes, which is what I think is really happening. Now, over in New Zealand, in an economic note titled Prepare for Higher Interest Rates, the ASB senior economist Mark Smith says the ASB are expecting the Reserve Bank to lift the official cash rate by 25 basis points in October to 0.5%, and then in November to 0.75%, and February next year to 1%, with the official cash rate ending 2022 at 1.5%. ASB is the country's second biggest home lender, with $67.7 billion worth of residential mortgage lending exposure as at the 30th of June in New Zealand. They calculate that every 1 percentage point increase in mortgage interest rates would add $3.3 billion to New Zealand households' debt servicing costs and see new mortgage interest rates back above 4% in about a year's time. However, they reckon that in the forthcoming cycle of interest rate rises, average mortgage costs are not likely to rise much above 4%, meaning the peak in the cycle will be at historically low levels. ASB expects new mortgage interest rates to rise 10 to 50 basis points across the curve before the end of the year, and a total of 30 to 125 basis points by the end of 2022. We expect these increases to come through a number of steps, particularly for short-term rates, rather than one big jump, Smith says. By late 2022, these increases would take new carded rates broadly back to where they were in late 2019. And he notes that due to mortgage fixing, borrowers will be temporarily shielded from the increase in mortgage rates. However, this shield is not particularly large, with close to 80% of mortgage debt due to roll over in the next 12 months. An average duration is actually about 10 months. So assuming household borrowing habits don't change, ASB forecasts that the average mortgage interest rate will climb by roughly 35 basis points by the end of the year, and the average rate faced by mortgage borrowers at the end of this year will still be very low at around 3.3%. That's 75 to 80 basis points below the early 2020 levels. The average effective mortgage interest rate is then expected to climb further, a further 65 basis points over 2022 to around 3.9%. That's slightly above the 50 basis point of official cash rate hikes that they expect. Although we don't expect OCR hikes over 2023, our estimates suggest the average effective mortgage rate will rise a further 30 basis points or so over 2023 to around 4.2%, and our rough forecasts are broadly consistent with recent Reserve Bank New Zealand research showing the impacts will take time to accrue. All up, ASB is expecting average mortgage interest rates to rise about 1.3% from now until the end of 2023, taking them back to those levels of 2019. The higher debt servicing costs should be manageable for most households, but those with large debt exposures would feel the cash flow hit. For borrowers, we reiterate our earlier message that it would be prudent to budget and prepare for higher future debt servicing costs. And Smith said since Reserve Bank figures from July suggest the actual average borrowing interest rate paid by mortgage holders at that stage was around 2.9%. That's a record low. Our estimates suggest that on net basis, for every 1 percentage point increase in customer interest rates, that would reduce household cash flows by roughly $2.6 billion or 1% of disposable income. Every 1 percentage point lift in mortgage interest rates would raise household debt servicing costs by around $3.3 billion per annum. But a 1% increase in term deposit interest rates, assuming a 17.5% marginal tax rate, would deliver an additional after-tax cash flow of $675 million per annum. And he says household debt servicing costs look to be manageable, and households in aggregate should have a reasonable buffer to cope with modestly higher mortgage interest rates. However, many households have maintained their debt repayments at the time of falling mortgage rates, paying off additional principal and building up a larger buffer. The Reserve Bank New Zealand figures suggest that since the end of 2019, mortgage holders made more than $22 billion in excess repayments. Households could choose to lengthen the duration of their lending when borrowing rates climb, smoothing the impact. And he said that higher mortgage interest rates should, however, sharply slow housing market momentum, with prices largely expected to flatline over 2022. But in terms of economic activity, the gradual pace of the cash rate hikes is unlikely, they say, to derail the economic expansion, and so shouldn't significantly weigh on household incomes and employment. Of course, the problem here is you've got to look granularly. Again, as I always say, you can't just look at an aggregate level. There will be a number of households trapped with high amounts of debt in a rising interest rate environment. That will put downward pressure on house prices, of course, but also put massive additional pressure on households. And finally, from Zero Hedge, they say household net worth hit $142 trillion in the US, up $31 trillion since COVID hit. But there's a catch. Another quarter, another record high of 1% household net worth, they said. The Fed's latest flow of funds report released yesterday showed the latest snapshot on the US household sector as at the 30th of June 21, which confirmed that 1 year after the biggest drop in household net worth, which was a $8 trillion wipeout in the first quarter of 2020, in the second quarter of 2021, the net worth of US households soared by another $5.8 trillion or 4.3%, rising to a new high of $141.7 trillion. As has originally been the case, real estate at $34.9 trillion and directly and indirectly held corporate equities at $47 trillion were the largest components of household net worth. Meanwhile, household debt, seasonally adjusted, was $17.3 trillion, a grand total of $31 trillion. And since the bulk of this wealth goes to a fraction of the wealthiest 1%, it means that the COVID pandemic has been the biggest wealth transfer in history, making America's richest even richer. Looking at the composition of the wealth changes, $3.54 trillion came from a gain in stocks, $1.2 trillion was from an increase in real estate values, the biggest quarterly increase in housing values on record, another $1.1 trillion came from other sources. It wasn't just housing and real estate. Net private savings grew to an annualized pace of almost $2.9 trillion in the second quarter after a $4.8 trillion surge in the prior quarter, which still is a very high number, and it suggests that almost $2 trillion in excess savings have already been spent. Excess savings have been a key driver of consumer spending, including last quarter, where consumer outlays jumped to one of the fastest paces on record. Of course, in addition to assets Liabilities also grew, and in the second quarter of 21, household debt grew by 7.9%. That's a more rapid pace than in previous quarters, as home mortgages surged by 8%, spurred by rising home prices and sale activity, as well as by the Fed keeping borrowing costs near zero. That's led to record low mortgage rates, which have bolstered demand for homes. The median selling price for previously owned homes is at a record high, and homeowners' real estate holdings, minus the change in mortgage debt, rose $879.7 billion, a positive value, indicates that the value of real estate is growing at a faster pace than household mortgage debt. Meanwhile, non-mortgage customer credit increased by 8.6% as credit cards, auto loans and student debt all increased. Non-financial business debt grew at a rate of 1.4%, reflecting continuing growth in commercial mortgages, non-bank loans and corporate bonds, and a decline in non-mortgage depository loans. And federal debt rose 9.6%. State and local debt increased 3.1%. As GDP continued to grow, the ratio of non-financial debt to GDP edged down just a little. In the second quarter of 2020, the ratio had spiked, driven by the drop in GDP and the expansion in federal debt related to the fiscal stimulus. Looking at the various components of non-financial business debt, non-mortgage deposit loans to non-financial businesses decreased $143 billion in the first quarter. Contributing to the decline was the forgiveness of many loans extended under the Paycheck Protection Program, the PPP, which more than offset the extension of new PPP loans. However, non-mortgage deposit loans declined, even excluding PPP loans. More than 400 million of PPP loans were in the lender's balance sheet at the end of the second quarter, and thus are still included in the measure of non-financial business debt. However, a large fraction of them is expected to be forgiven. In contrast to non-mortgage depository loans, commercial mortgages and non-bank loans continue to increase, and corporate bonds also increased, though at a slower pace than in the first quarter. Overall, outstanding non-financial corporate debt was $11.2 trillion. Corporate bonds, at roughly $6.6 trillion, accounted for 59% of the total. And non-mortgage depository loans were about $1 trillion. Other types of debt included loans from non-bank institutions, loans from the federal government, and commercial paper. And the non-financial, non-corporate business sector consists mostly of smaller businesses, which are typically not incorporated. Non-financial, non-incorporated business debt was $6.7 trillion, of which $4.7 trillion were mortgage loans and $1.6 trillion were non-mortgage depository loans. There is, as usual, a catch, as unfortunately most Americans aren't benefiting from recent gains in wealth. And while the pandemic has led to a surge in savings and opportunities for many to buy a home or invest while pushing up the financial assets of the top 10% to record highs, the downturn has disproportionately impacted low-income workers, many of whom rent and don't participate in the stock market. Indeed, the latest data, as at the first quarter, shows that the top 1% accounts for more than $41.5 trillion of total household net worth, with the number rising to over $90 trillion for just the top 10%. Meanwhile, the bottom half of the US population had virtually no assets at all, and on a percentage basis, just the top 1% now owns a record 32.1% share of total US net worth, or $45.6 trillion. In other words, the richest Americans have never owned a greater share of US household income than they do now, largely thanks to the Fed. Meanwhile, the bottom of 50% own just 2% of all net worth, or a paltry $2.8 trillion. They do own most of the debt, though. And that is precisely the point. There's a very similar trend going on here in Australia too. There is unequal distribution between the affluent and those who are less affluent, and the debt is very much piled at the bottom end of the income distribution curve and amongst those who have very limited assets. The problem with all of this is that if interest rates do start to rise, as perhaps New Zealand is forecasting, and that spreads to other economies too, this will turn things on their head quite quickly. And this inordinate ill distribution between the rich and the poor is something which, structurally speaking, should be considered, and policies need to be put in place to reverse it, unless you want to continue to follow the US into that distribution disequilibrium, which puts most of the assets at the 1% most affluent and most of the debt amongst those who are least able to service it. That is not very equitable, it's not very fair, but it is a consequence of the financialisation of property and the financialisation of society. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.